This video is a review of Tokio Marine's fiscal year 2024 full-year financial results, period from April 2024 to March 2025. Tokio Marine is Japan's oldest insurance company, founded in 1879, and is now a major global insurance group headquartered in Tokyo. It operates in more than 40 countries and regions, offering a wide range of general and life insurance products. Regarding the fiscal year 2024 results, Tokio Marine recorded an adjusted net income of 608.9 billion yen, 6% increase year-on-year, excluding gains from the sale of strategic equity holdings. This increase was primarily due to favorable exchange rate effects that reduced foreign currency-denominated claim reserves in the Japan property and casualty segment. The normalized net income, excluding one-off factors, was 679 billion yen, matching forecasts and showing a 14% increase year-over-year. This growth was driven by strong international performance, beneficial currency movements, and rate increases in the Japan property and casualty segment, along with fewer large-scale accidents. Tokio Marine also noted that strategic equity sales reached 922 billion yen, surpassing the initial projection by 100 billion yen. Including these gains, the total adjusted net income rose to 1,215 billion yen, 1.7 times higher than the previous year. For fiscal year 2025, Tokio Marine expects adjusted net income of 700 billion yen, a 3% increase from the previous year, excluding equity gains. The total adjusted net income including equity gains is projected to be 1.1 trillion yen, assuming 600 billion yen in equity sales. Shareholder return policy. In fiscal year 2024, DPS dividends per share were raised to 172 yen, a 40% year-on-year increase. For fiscal year 2025, they plan another increase to 210 yen, representing 22% growth. Tokio Marine also plans to repurchase 220 billion yen worth of its own shares over the fiscal year, with an initial resolution of 110 billion yen already approved. These shareholder returns are part of a disciplined capital policy aimed at enhancing EPS and ROE through balanced capital allocation and opportunistic investments. On the top line, net premiums written in fiscal year 2024 grew 10% year-over-year, or 6% excluding currency effects. Life insurance premiums fell 44% due to reinsurance transactions. In fiscal year 2025, the company expects 3% growth in net premiums written and a 45% increase in life insurance premiums, again influenced by reinsurance structuring. From a business segment perspective, Japan property and casualty saw a net income increase of 28.8 billion yen, despite headwinds like higher loss costs and natural disaster reserves, thanks to favorable rate changes and fewer large losses. International operations showed a 29.7 billion yen increase, driven by solid underwriting and investment income, and aided by yen depreciation. For fiscal year 2025, Tokio Marine expects adjusted net income to be 700 billion yen if capital gains from selling business-related stocks are excluded. Since the company plans to sell about 600 billion yen worth of these stocks, adjusted net income including those gains is expected to be 1.1 trillion yen, 3% increase year-on-year. In Japan, the property and casualty insurance business is expected to grow by 7%. This happens despite lower dividend income from selling stocks and higher IT costs. The growth comes mainly from not needing to set aside extra reserves for North American liability insurance, as was done last year, and from planned price increases in auto insurance. The international business looks flat due to the stronger yen, but is actually expected to grow by 5%, thanks to strong performance from key overseas companies and a recovery in Asian life insurance. Tokio Marine follows a dividend growth philosophy, aiming to raise DPS dividend per share in line with profit growth. In fiscal year 2024, Tokio Marine increased its dividend per share to 172 yen, up 40% year-on-year, reflecting higher profits. For fiscal year 2025, the dividend is projected to rise further to 210 yen, a 22% increase, marking the 14th consecutive year of dividend growth. Tokio Marine aims to maintain a 50% payout ratio based on a 5-year average of adjusted net income. They state that the dividend will not be decreased and that, with a progressive dividend policy, strong shareholder returns can be expected in the future. As of March 31st, 2025, Tokio Marine's ESR, economic solvency ratio, stands at a healthy 149%. For fiscal year 2025, the company plans to repurchase shares worth 220 billion yen over the course of the year. As a first step, a 110 billion yen share buyback has already been approved. This plan reflects a comprehensive assessment of factors such as the capital required to support 2% EPS growth, the current M&A pipeline, and the company's overall capital position. Tokio Marine will also continue to sell its strategic equity holdings aggressively, reducing cross-shareholdings, shares held in partner or client companies for strategic or business relationship purposes, as part of its efforts to improve capital efficiency and strengthen corporate governance. In fiscal year 2024, they sold 922 billion yen worth, far exceeding the original 600 billion yen plan. Tokio Marine remains committed to halving its 2023 strategic equity balance by fiscal year 2026 and reaching zero by fiscal year 2029. Stock price. This is the Japanese yen base chart for the last 1 year. The Japanese yen stock price is 6,198 yen as of June 6th, and the US dollar stock price is $43.29 as of June 6th. The stock price has been staying at a high level and has recently continued to rise, reaching the 6,000 yen range again. The current PBR is 2.34, and the PER is 12.8, with a dividend yield of 3.39%. Compared to the past few years, the PBR and PER suggests that the stock is slightly overvalued, but the dividend yield is somewhat higher than in previous years. Conclusion. Tokio Marine delivered strong financial results for fiscal year 2024, driven by solid international performance, favorable currency effects, and strategic equity sales. Adjusted net income rose significantly, and the company continues to demonstrate disciplined capital management through rising dividends and large-scale share buybacks. Progressive dividend policy and plans to further reduce cross-shareholdings. Tokio Marine is well-positioned to enhance shareholder value. Looking ahead, steady profit growth and strategic investments are expected to support continued performance in fiscal year 2025.